You could be facing serious penalties and huge unexpected bills just for making money online. Affiliate marketing is a powerful way to earn income, but many people completely miss the crucial tax side. It is not a casual hobby when you consistently make a profit. The Internal Revenue Service views this as a business operation. Even if you are just one person working from your kitchen table, you are a sole proprietor by default. This means your personal assets are tied to your business liabilities, which is a huge risk. Many people choose to form an LLC, a limited liability company for personal asset protection, and some tax flexibility. An S-Corp election is another popular choice, especially once profits reach significant levels like $60,000 or more per year. This can offer substantial self-employment tax savings. You would pay yourself a reasonable salary, and the remaining profit is distributed as dividends, avoiding that full 15.3% self-employment tax on the entire amount. This election can be complex, but the potential savings are immense. Consult a tax advisor to see if an S-Corp election is right for your specific situation. The first step in this whole tax journey is understanding your tax identification number. As a sole proprietor, your social security number is typically used. However, it is always better to obtain an EIN, an employer identification number, from the IRS. It adds a layer of professionalism and keeps your social security number more private. When you sign up for affiliate programs, you will often fill out a W-9 form. This form tells the company paying you your tax ID and certification that you are a U.S. person. They need this to report their payments to you to the IRS. If you do not provide it, they might withhold 24% of your earnings for tax purposes, a practice called backup withholding. That is a lot of money to lose upfront, potentially hundreds or thousands of dollars from your first payouts. Imagine losing nearly 1/4 of every payment immediately. Your affiliate income is considered ordinary income. This means it is taxed at your regular individual income tax rates, but the great news is you can deduct business expenses. Think of it like this. Gross revenue is all the money you make. Net profit is what is left after you subtract your legitimate business expenses. You only pay tax on the net profit. This is why keeping impeccable records is not just good practice. It is absolutely essential. Every single dollar spent on your affiliate business could be a deduction. Even a single $10 payment for a stock photo could save you money. A $20 subscription for a font library matters. What counts as a deduction? A lot, actually. Your website hosting fees, for example. Domain name registration. Software subscriptions for email marketing tools. Graphic design programs. Keyword research software, advertising costs like Google ads or Facebook ads, payment processing fees, professional development courses or ebooks related to your niche, home office deduction if you have a dedicated space used regularly and exclusively for business. This means a percentage of your rent or mortgage utilities, internet, and home insurance. For example, if your home office is 200 square feet and your home is 2,000 square feet, you could deduct 10% of those home expenses. This could amount to hundreds of dollars each year. Millage if you drive for business purposes, for example, to a conference or to meet a client, at 67 cents per mile for 2024. Business use of your phone, bank fees associated with your business account, even legal and accounting fees are deductible. A new laptop, a new monitor, anything solely used for business purposes. Office supplies like paper pens and printer ink. Internet service provider fees, cloud storage solutions, membership fees for business-related communities, photography equipment used for content creation, software licenses for video editing. The list is long, and every single one reduces your taxable income. Many affiliates make a major error by not separating business and personal finances. Get a dedicated business bank account. It makes tracking infinitely easier and much cleaner for an accountant or in case of an audit. Use accounting software like QuickBooks, Self-Employed Zero, or Wave to track every penny. Categorize everything correctly. This information feeds directly into your Schedule C profit or loss from business form, which you file with your personal tax return form 1040. Failing to do this can lead to massive headaches during tax season and potentially missed deductions that cost you hundreds or even thousands of dollars. It can also raise red flags with the IRS. Increasing your audit risk. One of the biggest surprises for new affiliate marketers is quarterly estimated taxes. If you expect to owe at least $1,000 in taxes for the year, you likely need to pay estimated taxes throughout the year. The IRS wants their money as you earn it, not all at once on April 15. These payments are due on April 15, June 15, September 15, and January 15 of the next year. If any of these dates fall on a weekend or holiday, the deadline shifts to the next business day. If you underpay, the IRS will hit you with penalties and interest. This happens often. The penalty for underpayment is calculated based on the amount of underpayment and the number of days it was unpaid. Currently at 8% interest for 2024, imagine earning $5,000 in profit in a quarter. You might owe over $1,000 in combined federal and self-employment taxes for that quarter alone. It adds up fast and can easily catch you off guard if you are not prepared. Self-employment tax is another massive point of confusion. This covers your Social Security and Medicare contributions. It is a whopping 15.3% on your net earnings, comprised of 12.4% for Social Security and 2.9% for Medicare. This is on top of your regular income tax. For 2024, Social Security tax applies to net earnings up to $168,600. Medicare tax applies to all your net earnings. No limit there. This is a significant chunk of your profit. For instance, if you net $30,000, you would owe approximately $4,590 in self-employment taxes alone. That is a lot. If your net earnings hit $100,000, your self-employment tax would be $15,300. These numbers demand serious attention and proper financial planning, especially since you pay both the employer and employee portion. Do not forget state income taxes. Some states have no income tax, like Florida, Texas, or Washington. Other states have very high income taxes. Like California or New York, your state tax obligations depend on where you live and where your business operates, which is usually your home address for online businesses. State tax rates can range from 0% to over 13% of your income. Some states also have sales tax implications generally. Affiliate marketers only facilitate sales, not make them directly. So sales tax usually is not an issue for commission earnings. But if you also sell your own digital products or physical goods, then you would need to collect and remit sales tax. This is a complex area and varies wildly by state, often requiring registration for a sales tax permit. Ignoring state taxes can lead to separate state-level penalties and audits. International considerations can also pop up. If you are a U.S. affiliate and you work with an international company that pays you, they will still need your tax ID. If you are not a U.S. person but earn income from U.S.-based affiliate programs, you would typically fill out a Form W-8 Ben Certificate of Foreign Status of Beneficial Owner for United States Tax Withholding and Reporting. This helps them determine if a tax treaty exists between your country and the U.S., which could reduce or eliminate the withholding tax. Without it, a 30% withholding tax could be applied to your gross earnings. That is a huge reduction, impacting a significant portion of your income before it even reaches you. Understanding these global rules is essential for international earnings. Working with a qualified tax professional is often the best investment you can make. They can help you identify all eligible deductions, set up proper record-keeping systems, calculate estimated taxes accurately, and advise on entity structure. Trying to navigate this alone can lead to costly mistakes, missed deductions, or even audits. Imagine missing out on $5,000 in deductions because you did not know they applied. That could easily save you hundreds or even thousands in taxes. Depending on your tax bracket, a good accountant can save you more money than they cost. This specialized advice ensures you stay compliant and optimize your tax burden, providing real peace of mind. Common pitfalls include not tracking income from every single affiliate program, especially if you work with 20 or 30 different ones. Mixing personal and business expenses, like buying groceries with your business debit card, forgetting to pay quarterly estimated taxes, a very common error, resulting in penalties. Ignoring state tax requirements, thinking federal is all that matters. Not understanding the difference between gross revenue and net profit, and therefore overestimating your true income. Thinking of your affiliate income as play money rather than serious business earnings, all these can lead to a messy tax situation. Fines and immense stress during tax season. The IRS has sophisticated algorithms to flag inconsistent tax returns. Consider an affiliate earning $10,000 in gross revenue each month, but they have $2,000 in monthly expenses for tools, advertising, and education. their net profit is $8,000 over 12 months. That is $96,000 in net profit. On this amount, self-employment tax alone would be almost $14,700. Add federal and state income taxes, and their total tax bill could easily be $30,000 or more. If they do not save for this, they will be in a terrible spot, potentially owing the government thousands they do not have. This scenario plays out for countless affiliate marketers, often leading to overwhelming debt or even selling assets to cover tax bills. Even small amounts count. If your net earnings from self-employment are $400 or more, you must file a tax return and pay self-employment taxes. Below $400, it is still income, but the self-employment tax does not apply. However, it is still subject to income tax. Every penny counts. It is crucial to report all income regardless of the amount. The IRS has access to third-party payment network data, so they know how much you are earning. The journey from a casual online earner to a professional affiliate marketer demands a solid understanding of these tax principles. It is not glamorous, but it is absolutely crucial for financial success and peace of mind. Without proper planning and execution, your affiliate income could turn into a financial headache instead of a source of wealth. This includes saving approximately 25 to 35% of your net profit for taxes. It is a lot of money to set aside, but absolutely necessary to avoid future problems. You need a dedicated tax savings fund. Ensuring you have documentation for every claim is vital. Keep all receipts. Digital copies are perfect. Scan them, maintain spreadsheets detailing every transaction, record the date, amount, vendor, and purpose for every single expense. This discipline will save you immense stress if the IRS ever comes knocking. They love records. The better organized you are, the smoother your tax life will be. This is your business. Treat it like one. And remember, the statute of limitations for the IRS to audit a return is generally 3 years from the date you filed it. But if they suspect substantial underreporting of income, this period can extend to 6 years. Fraud has no statute of limitations, so keep those records. Year after year, it truly matters. An audit is a scary prospect. Proper records are your best defense.